And there you have it, the closing bell at the New York Stock Exchange. U.S. stocks rose today as shares of companies from the tech to finance sectors advanced. The Dow Jones ended the day up around 500 points. The Nasdaq climbed around 2.6%, while the S&P 500 gained nearly 2%. Joining us now is Greg Swenson. Greg is a founding partner of merchant banking firm Brigg McAdam. Greg, thanks for being here. Don't look now. Modest little winning streak. What was driving things today?
Well, I think, Jim, it was really a relief rally. You can argue that the market was oversold, but I think the oversold argument is temporary. And, this is probably, if anything, a selling opportunity, because I think there's still a lot of headwinds in the markets and definitely in the real economy, which should be reflected in the market. So, nice to see it. Again, selling opportunity, if anything. The market's had a rough couple of months. So, there were going to be some moments where the algorithms would kick in. But I think if anything, stay with the same story, avoid tech, avoid long duration assets, and stick with, energy, healthcare, and staples that, and just ride out this cycle. And I think we're still early in the cycle.
So you're doing this very nicely, Greg, and we appreciate it, but you're definitely throwing some cold water on anybody who's saying, okay, good, I can be optimistic now. This near term and even long term is an entirely unsettled picture.
Yes, you're right, Jim. And I always try to, be positive and look at the bright side. But, the consumer sentiment is really negative right now, both consumer sentiment and investor sentiment. Great investor sentiment, picked up today. But, 37.1% of consumers feel worse off versus, 31.9% at the peak of COVID. So this is a really negative, sort of leading indicator that I think, given the dependency on GDP growth, dependency on the U.S. consumer, this is a really bad sign. So, look, I think, take advantage of the, buying opportunities. If there's equities that you like and you want to buy them cheaply, great. But I think this is temporary. And I think there's still a lot of headwinds between consumer confidence and inflation that's going to be sticky. So I think, we still have some headwinds ahead.
All right, well, let me ask you, if you will, one more sort of specific data point. The market
Sure.
continuing to digest the Federal Reserve minutes that suggest the central bank could slow down rate hiking at some point soon, maybe. So is this going to factor into the overall picture of what shrewd investors are using to calculate what to do?
Of course. I mean, it will factor in, but the Fed has been wrong so much over the last 2 years. So I wouldn't necessarily take any of their comments too seriously, because they've been wrong so often. If anything, they have to, raise rates quickly. I think the other factor that people don't, they pay attention to the Fed funds rate. But remember, the quantitative easing is ending. And if you look at the charts from 2007 until now, financial assets are still at 2.5 times GDP, when the historical trend is 1.5 times GDP. If it continues to correct, you still have some serious downside to the market. So there's some technical factors here. Even if the Fed doesn't hike as much as the markets are anticipating, you still have the end of QE that I think is a significant factor.
This is really helpful and important insight. Greg Swenson, thank you so much.
Great to be here. Thanks, Jim.